Hello. If you have traveled abroad recently, paid for imported products, or simply filled your car's tank, you may have noticed that one number matters more than what most people realize: the rupee dollar exchange rate. Over the past few months, the rupee has come under pressure. The Iran conflict and the closure of the Strait of Hormuz threatened to create a perfect storm for India: higher oil prices, capital outflows, and a weakening rupee. But now the narrative appears to be shifting. Oil prices have moderated after reports that diplomatic efforts may have prevented a prolonged disruption in the Strait of Hormuz. At the same time, the Reserve Bank of India and the government introduced some measures to attract foreign currency inflows and strengthen India's external position. So, is the rupee out of danger? Or are we simply seeing a temporary recovery while deeper vulnerabilities remain? Today, I want to unpack what has happened to the rupee, what policymakers are doing about it, and most importantly, what India must do if it wants a stronger and more resilient currency in the long run. So let's start with, why did the rupee come under pressure? To understand the recent exchange rate movements, we will start with a simple principle. The exchange rate is the price of dollars in rupee terms. So therefore, it is determined by demand and supply of dollars. When demand for dollar rises relative to supply, its price goes up, which means the rupee depreciates. This is exactly what happened. The first shock to the rupee came from the US Iran conflict and concerns about the ships passing through the Strait of Hormuz, one of the world's most important energy choke points. Roughly one-fifth of globally traded oil passes through this narrow waterway. So any threat to shipping immediately raises the fears of supply disruptions and higher oil prices. For India, this matters a lot. India imports most of its crude oil requirements. Therefore, when oil prices rise, India has to pay more dollars for the same oil imports. This increases the demand for dollars in India's foreign exchange market and therefore increases the price of dollars, which is the same as saying puts downward pressure on the rupee or causes a depreciation of the rupee. Secondly, financial markets. Now, what happens is, if there's geopolitical uncertainty, there is a flight of capital to safety. What it means is, investors shift their money from emerging markets towards assets that are perceived as safer, such as the US Treasury bonds and other dollar denominated investments. So, as financial capital moved out of emerging markets, including India, the availability of dollars fell in India, worsening the rupee's crisis. And of course, more expensive oil caused dollar outflow, and dollar moved out because of global uncertainty, and both these forces pushed the rupee downwards. This is a classic example of how geopolitics can influence macroeconomic outcomes thousands of miles away from the actual conflict zone. Let's talk about, will the rupee recover? So let us turn to the reasons for optimism. The RBI introduced some measures to attract more dollar inflows, particularly through FCNRB, or foreign currency non-resident deposits in banks that are held by NRIs. More dollar inflows mean greater supply of dollars, which helps to stabilize the rupee. Secondly, the government increased the import duty on gold imports. That reduced the demand for dollars because you need dollars to import gold. So when dollar demand fell, the price of dollar also fell. The third reason for optimism is the recent easing of fears surrounding the blockage at the Strait of Hormuz. Recently, there is an announcement of a US-Iran deal, so that has raised hopes that shipping routes will remain open and a broader escalation can be avoided now. Oil markets have reacted almost immediately with a drop in prices. Lower oil prices improve India's future trade balance. It reduces expected dollar demand and hence supports the rupee's recovery. At this point, it would be useful to introduce one of the most important ideas in international macroeconomics. It is known as the impossible trinity, also the Mundell-Fleming trilemma. According to this impossible trinity, a country cannot simultaneously achieve all of the following three options. First, a fixed exchange rate. Second, free capital mobility, which means forex inflows and outflows. And third, an independent monetary policy. A country can choose only two out of these three options. India has largely chosen an independent monetary policy, which is used for managing domestic inflation and domestic growth. And India has chosen relatively open capital flows. This means exchange rate cannot be controlled. It is going to be flexible. So when global investors withdraw capital, or when oil prices surge, the RBI cannot simply freeze the exchange rate without sacrificing monetary policy independence or without imposing capital controls. In other words, some movement in the rupee is not necessarily a sign of policy failure. Some movement in the currency rate is often the natural consequence of allowing the economy to adjust to external shocks while preserving domestic policy autonomy. The RBI's objective is therefore not to target a specific exchange rate level. Rather, its mandate is to prevent disorderly market conditions and excessive volatility of the exchange rate. This is why measures such as the FCNRB deposits are important. They provide support to the rupee without forcing the RBI to abandon its broader monetary policy objectives, which is oriented towards controlling inflation and supporting domestic growth. Together, easing geopolitical tensions and stronger capital inflows are improving sentiment towards the Indian currency. Now, a broader macroeconomic lesson. Every few years, India goes through a familiar cycle. When global oil prices go up, the current account deficit, that is the gap between imports and exports, widens, the rupee weakens, the policymakers respond, and the situation stabilizes. After some time, the cycle repeats. Why does this happen? Because the fundamental issue lies deeper than geopolitical events. The exchange rate is ultimately a reflection of underlying fundamentals of the economy. One of the most important identities in international macroeconomics is the balance of payments equation, which says that the current account balance, that is the export import gap, plus the capital account balance, which is the investment inflow outflow gap, equals the balance of payment position of a country. So if a country imports more than it exports, it has to attract foreign capital to finance the difference. India has historically run current account deficits, largely because of high energy imports, because of strong domestic demand. Normally, this is not a problem. Many rapidly growing economies run current account deficits. But the challenge is that such economies become dependent on continuous capital inflows. Whenever those capital inflows weaken, the exchange rate becomes vulnerable. That is exactly what we have been witnessing in the recent weeks or months. Now let's look at a long-term solution. So what is the ultimate solution to the exchange rate problem? It is not attracting capital inflows through temporary measures. It is not hoping for lower oil prices, not even maintaining huge foreign exchange reserves. The ultimate solution to the exchange rate problem is productivity growth of the economy. Now, this may sound abstract, but productivity is the single most important determinant of long-run exchange rate strength. Why does productivity matter? Because productivity determines how efficiently an economy converts inputs into output. Inputs such as labor, capital, technology into output, that is GDP of the economy. Countries that are more productive are able to produce more output and are more competitive in the global markets, which means higher exports, and more foreign investment inflows, faster economic growth, and stronger external balances. And ultimately, the currency becomes stronger. In macroeconomics, this is closely related to an idea known as the Balassa-Samuelson hypothesis. According to the Balassa-Samuelson theory, countries that experience faster productivity growth particularly in internationally traded sectors, tend to experience a long run appreciation of their real exchange rate. The intuition behind this is following. When productivity of the economy rises, workers are able to demand and earn more wages, so they have now higher incomes. So, therefore, that translates into stronger domestic demand, which in turn attracts more investments. As these productivity gains accumulate, the economy becomes more competitive in the global markets, and therefore the currency tends to become stronger in real terms. This is precisely what has happened in South Korea, Taiwan, Singapore, and even in China. Their currencies have become more resilient, not because their central banks have been intervening in the foreign exchange markets to manage the currency, but because their productive capacity increased dramatically over several decades. The obvious question then is, how can India increase the economy's productivity? Well, we have the answers from economics research. First, we need better human capital, which means better quality schools, stronger universities, vocational training, digital skills, and workforce development. All these will raise labor productivity. We need to invest in infrastructure, build more ports, highways, freight corridors, better power supply, digital infrastructure. These will reduce business costs and improve the economy's competitiveness. We need to encourage innovation, more research and development, artificial intelligence, advanced manufacturing, and technology adoption can improve productivity growth. We need improvement in the ease of doing business. This can be achieved by reducing regulatory burdens, improving contract enforcement, which will allow firms to operate more efficiently. We need to strengthen our manufacturing sector. India's effort to become a manufacturing hub is not just an industrial policy objective, but it will help the exchange rate, because a stronger manufacturing sector will be more competitive in global markets, and those exports will then improve foreign exchange inflows and help the rupee. So the important point is that a strong rupee is ultimately a story of the economy's productivity. Now, there are other structural solutions to the exchange rate problem. Beyond productivity, there are several other complementary reforms that can strengthen the rupee over time, such as energy security. India's huge dependence on imported oil is one of its biggest vulnerabilities, and that is why every major oil shock eventually finds its way into India's current account deficit and hurts the exchange rate. So we need greater investment in renewable energy, nuclear power, electric mobility, green hydrogen, which can reduce this dependence on oil imports. Export diversification will help. A country that relies on a narrow export base is more vulnerable to export shocks. We have seen the dependence on US as a major export market has hurt us. India's success in software and business services have been remarkable, but strengthening exports in electronics, pharma, engineering goods, defense manufacturing, and across export markets will make our export earnings more resilient, more stable. And we need stable foreign investments. In economics, we distinguish between short term portfolio flows, FIIs or FPIs, versus long term stable inflows, that is, foreign direct investment or FDI. Portfolio flows can come in quickly but also leave quickly when global uncertainty rises. It's often called hot money. But FDI is more stable. It is associated also with technology transfer, productivity improvements, and helping export grow the economy. So, from an exchange rate perspective, attracting long term stable FDI is far more valuable than relying on investment flows or portfolio flows. Fiscal discipline of the government is important because fiscal deficit can contribute to external imbalance through what economists call the twin deficit hypothesis. It means that high fiscal deficit may translate into a large current account deficit because more spending by the government could spill over into imports. So we need to bring the fiscal deficit down further. which will help to reduce external vulnerability and also strengthen investors' confidence in investing in the Indian economy. Inflation stability matters for the exchange rate. One of the key findings in macroeconomics research is that countries with persistently high inflation tend to experience currency depreciation. So, maintaining low and stable inflation is important for exchange rate stability. And this is the reason why inflation targeting is very, very important for monetary policy. And in India, the RBI maintains 4% inflation by using its monetary policy, and they need to continue to keep focus on domestic inflation. Let me leave you with four key takeaways. First, the recent rupee weakness was triggered by a combination of oil price fears because of the Strait of Hormuz closure and capital outflows towards safer global assets. Second, the easing of geopolitical tensions because of the recent announcement of a Iran US deal and RBI's measures to attract more foreign currency inflows might provide short term support to the rupee. Third, the impossible trinity reminds us that India cannot simultaneously maintain a fixed exchange rate, free capital flows, and independent monetary policy. So, therefore, some exchange rate flexibility is inevitable and also desirable as a shock absorber. And finally, the Balassa Samuelson hypothesis reminds us that currencies become stronger when the economy becomes more productive. So, therefore, in the end, exchange rate is ultimately a mirror that reflects the economy's underlying strengths and weaknesses. So, if India wants a stronger and more resilient rupee, the answer lies not just in the forex markets, but in improving the strength of the real economy. Do you agree? Let me know what you think.